Welcome to Personal Finance Deep Dives, where we help you make your money work for you. Today, we're plunging into a question that sits at the very heart of sound financial planning. What is the fundamental difference between saving and investing? And maybe more importantly, how do we determine which strategy is truly right for our unique financial goals? On the surface, these terms might seem interchangeable, even synonymous maybe, but I assure you, understanding their distinct roles is absolutely critical for building lasting wealth.
That's exactly right. While both saving and investing are, well, indispensable tools for building a robust financial foundation and accumulating wealth over time, they serve remarkably distinct purposes. They come with different risk profiles, different time horizons, and, frankly, vastly different potential rewards. Our mission today is to kind of demystify these differences for you so you can confidently make informed decisions about where and how to allocate your hard-earned money. We'll meticulously explore the core characteristics of each approach, weigh their pros and cons, and crucially, clarify precisely when to lean on one strategy over the other to best serve your financial aspirations.
Okay, let's begin by exploring the common ground. What do saving and investing actually share? Because I think it's precisely this shared purpose that often leads to the initial confusion for many people. What do they both set out to achieve for us financially?
That's a great starting point because you're right, they do have a foundational commonality.
Hmm.
At their core, both saving and investing are strategies specifically designed to help you accumulate money for future use. It's really about consciously setting aside funds today
Yeah.
so that you possess a greater quantity of those funds tomorrow. Whether tomorrow means, next month or several decades down the line, it's basically deferred gratification for future financial security or opportunity.
So we're talking about putting money away now to benefit from it later. Simple enough. What does that practically look like? I mean, where do we actually hold this money?
Well, yeah, to achieve that accumulation, both strategies fundamentally require you to use specialized accounts, typically facilitated through a financial institution. When you're focused on saving, your primary venues are usually traditional banks or credit unions. You're utilizing accounts like standard savings accounts, certificates of deposit, or money market accounts. So these are, familiar institutions where we've traditionally managed our liquid assets.
Right, the usual suspects.
Exactly. For investing, on the other hand, you'll generally open an account with a brokerage firm. Think of major players in that space, like Charles Schwab or Fidelity. It's worth noting, though, that many traditional banks have also developed their own investment arms or partnerships, so the lines can sometimes blur a bit. But the underlying account types and their functions remain pretty distinct.
Okay. And before we really get into the unique aspects of each, is there a foundational financial step, something that applies to both, something you absolutely must have in place no matter which path you're choosing?
Absolutely, yes. And this is a non-negotiable step that applies universally. Before you even contemplate investing a significant sum, perhaps beyond, say, an employer 401k match,
Hmm.
it is absolutely critical to have money set aside specifically for emergencies. I really can't stress this enough. This fund acts as your indispensable financial cushion, a barrier between you and life's inevitable curveball.
Like a sudden job loss or a big car repair.
Exactly, or a substantial medical bill. Without this safety net, any unexpected expense could force you to dip into investments at a really bad time, potentially selling them at a loss. Or worse, resorting to high-interest debt. It's the foundational bedrock of any sound financial plan.
That's such a powerful point about the emergency fund. So, okay, if both help us accumulate money and use financial institutions, how do we start to separate them conceptually? What's the core distinction in their purpose?
I like to think about it this way. Money you save is primarily intended for your immediate or short-term needs, or as that crucial safety net we just discussed. It's about ensuring accessibility and security for the near future, typically for goals within, say, a few years. Money you invest, conversely, is money you are deliberately planning to leave untouched for a much more extended period, think 5, 10, 20 years, or even longer. This longer horizon allows that money the time it needs to truly grow, to benefit from compounding, and ultimately fund your long-term aspirations and dreams. It's really serving your future self.
Could you give us concise definitions then, just to make that distinction crystal clear?
Sure, when we talk about saving, we are referring to the straightforward act of incrementally putting money aside, most commonly into a bank account. People typically save for very specific, tangible goals that are relatively close at hand.
Like a car down payment next year.
Exactly. Or setting aside funds for a house down payment if you're looking to purchase in the next 3 to 5 years. Or, as we emphasized, building or replenishing your emergency fund. It's a direct, accessible, and largely risk-free approach to holding money. Investing, on the other hand, is a more active strategy where you commit your money with the explicit intention of growing its value over time. You do this by purchasing various assets that possess the inherent potential to increase in value or to generate income at a higher rate than a traditional savings account.
So things like stocks, bonds.
Right. Stocks, which represent ownership in companies, bonds, which are essentially loans to governments or corporations, diversified mutual funds and exchange-traded funds, or ETFs, which bundle many stocks or bonds together, and even real estate. The crucial element here is the potential for growth, which inherently comes with a corresponding degree of risk and the necessity of a longer time horizon.
That brings us to takeaway number one. While both saving and investing help you accumulate money for the future and use financial institutions, saving is generally for short-term goals and emergencies, while investing is for longer-term wealth growth. Okay, now that we've established that shared goal but different purpose, let's really unpack the core differences between saving and investing. It's absolutely crucial to grasp these distinctions because accurately aligning your financial actions with your specific goals depends entirely on it. If we, confuse these two, we might find our money isn't working for us as effectively or efficiently as it could be. We could end up short of our aspirations.
This is where the real nuance comes into play, yeah. And where the perceived similarity often masks critical operational differences and, most importantly, varying levels of risk. I think every individual really needs to grasp these differences. Let me explain precisely what I mean by breaking down several key characteristics that differentiate these two powerful financial approaches.
Okay, let's break it down.
First, let's consider the account type you'll typically use. When you're saving, you'll primarily be using, well, bank accounts. We're talking about very accessible and common instruments like standard savings accounts, certificates of deposit CDs, and money market accounts. These are generally offered by traditional banks and credit unions, places you're likely already familiar with.
Right, and for investing?
For investing, the primary vehicle is typically a brokerage account. These are specialized platforms provided by firms like Charles Schwab or Fidelity that allow you to buy, sell, and hold a wide array of financial instruments beyond just cash. So the institutional home for your money is often quite different.
Got it. What about the returns? That seems like a big one.
Huge difference. With saving, you generally receive a relatively low return. The interest rate is usually fixed or changes very slowly, and you know upfront, with a high degree of certainty, what you'll earn. It's predictable, yes, but often quite modest.
Sometimes depressingly modest.
Yeah, that can be true. Investing, conversely, carries the potential for significantly much higher returns. However, and this is a big however, that potential is inherently linked to the possibility of lower returns, or even the loss of your principal capital. Returns are absolutely not guaranteed. They fluctuate significantly, sometimes even day to day, based on market performance, economic conditions, company specifics, you name it.
So you hear about the S&P 500 averaging 10%, but that's not every year.
Not at all. That's an average over decades. And it includes years of really big gains and, frankly, some pretty significant losses, too. You don't get a steady 10% every single year. It's bumpy.
Which leads directly to risk, right?
Exactly. Risk. Saving, especially with FDIC-insured accounts, carries virtually no risk to your principal. The Federal Deposit Insurance Corporation guarantees deposits in bank accounts up to $250,000 per depositor, per FDIC-insured bank, per ownership category. This means that even if your bank were to fail, your principal up to that limit is protected. That provides an unparalleled sense of security.
Peace of mind, basically.
Absolutely. Investing, however, carries a varying but always present possibility of losing some or even all of your invested capital. There are absolutely no guarantees of return or principal preservation in investing. Your money is subject to market forces, and you must be comfortable with the possibility of seeing your account balance decline, especially in the short term.
Okay, so different accounts, different returns, different risk. What about the actual things you buy, the products?
Good question. For typical products, saving is pretty simple. You're primarily dealing with things like high-yield savings accounts, CDs, and money market accounts. These are financial products specifically designed for safety, accessibility, and maybe some modest predictable income. For investing, the landscape is much broader and, honestly, more complex. It encompasses individual stocks, various types of bonds, mutual funds, ETFs, and even physical assets like real estate. Each of these products is fundamentally designed with a primary objective of capital growth over time.
And the time horizon, how long are we talking?
This is a critical differentiator, the time horizon. Saving is unequivocally best suited for short-term goals, meaning money you anticipate needing in the near future, generally within, let's say, 1 to 5 years. You want that money readily available and safe for market swings. Investing, by contrast, is truly optimal for long-term goals, typically funds you won't need for 5 years or more, and ideally, much longer. This extended time frame is crucial because it allows your investments to ride out inevitable market fluctuations, recover from downturns, and truly benefit from the power of compounding.
What about how hard it is to actually do this stuff, the difficulty level?
Yeah, the difficulty level also differs significantly. Saving is relatively straightforward and accessible to everyone. You open an account, deposit money, it earns interest. Minimal learning curve.
Pretty easy.
Very easy. Investing, however, can be considerably more complex. It usually demands some dedicated research, an understanding of market dynamics, knowledge of different asset classes, and an honest assessment of your own risk tolerance. While getting started with diversified funds has become more accessible, effective long-term investing does require a commitment to learning and staying informed, at least somewhat.
Okay, that makes sense. What about inflation? That seems really important lately.
Hugely important. When we consider protection against inflation, the picture shifts dramatically. Saving offers only minimal protection, if any. If the interest rate your savings account earns is lower than the prevailing inflation rate, and often it is, then your money's purchasing power effectively diminishes over time.
Like you said, losing ground.
Exactly. If your savings earn 0.5%, but inflation is at 3%, your money's losing 2.5% of its buying power each year. That's a silent erosion of your wealth. Investing, conversely, offers significant potential for protection against inflation over the long term. Historically, diversified investments like stocks have consistently outpaced inflation. This allows your money not just to maintain its purchasing power, but to grow beyond it, increasing your real wealth.
What about costs? Is one cheaper than the other?
Generally, yes. Let's talk expense. Saving is usually quite inexpensive. You might encounter minimal monthly maintenance fees, though many accounts offer ways to waive these, or maybe regulatory fees like a Regulation D violation fee if you exceed federal withdrawal limits from a savings account. But overall, low cost. Investing, however, can incur various costs. These might include fund expense ratios, those annual fees charged by mutual funds or ETFs, or brokerage fees for certain services or specific types of trades, though less common now for basic stuff.
And taxes, right?
Crucially, yes. You will owe taxes on any realized capital gains or investment income in a taxable brokerage account. While many brokers now offer commission-free trading for stocks and ETFs, the underlying expenses of the funds themselves or taxes on gains remain important considerations.
Last one, liquidity. How easy is it to get your money back?
Good point. Liquidity. Saving generally offers very high liquidity. You can access your money quickly, often within a day or two, usually without penalty, unless it's locked in a CD.
Very accessible.
Very. Investing also offers a high degree of liquidity for many common assets, like stocks, bonds, ETFs. They can usually be converted to cash quickly on almost any weekday the markets are open. However, and this is the critical distinction, the amount of cash you receive depends entirely on the market value at the time of sale.
Ah, so you might get back less than you put in.
Precisely. If the market has declined since you invested, you could end up receiving less than your initial investment, unlike a savings account where your principal is preserved.
Wow, okay. So after breaking all of that down, what does this intricate web of differences truly mean for you, the listener, trying to make sense of your money?
It means understanding that each strategy is a distinct tool, designed for a distinct purpose. It's about knowing the nuances of how each functions, its inherent risks, its potential rewards. It's about being an intentional architect of your financial future, rather than just passively letting your money sit somewhere,
That brings us to takeaway number 2. Saving offers high safety and liquidity for short-term needs with lower returns, while investing provides the potential for higher long-term growth but comes with greater risk and value fluctuations. All right, let's zero in on saving now. While it might seem like the most basic financial action, maybe even a bit boring compared to investing, it's an absolutely essential component of any robust financial plan. I want to delve deeper into its specific advantages and disadvantages because truly understanding its full impact, I think, will empower your financial decisions.
Yeah, and what's often overlooked is that while saving is straightforward, its profound impact on your overall financial resilience is something everyone needs to appreciate fully. Let me outline the key pros of saving first, and why it really forms the bedrock of financial security. One of the most compelling advantages is its safety and guarantee. Savings accounts are, for all practical purposes, incredibly safe. They offer you complete predictability, telling you precisely how much interest you'll earn up front. And crucially, as we've discussed, they're insured by the FDIC up to $250,000 per depositor, per insured bank, per ownership category.
That FDIC insurance is huge for peace of mind.
It is. It means your principal, the money you put in, is protected even if the bank itself were to fail. This level of principal guarantee is something you simply cannot get with investing, and it's invaluable for certain funds.
Makes sense. What else?
Then there's high liquidity. Your saved funds are generally very accessible. You can typically get your money when you need it, often within a day or two.
Yeah.
And usually without any financial penalty, unless you've committed to a CD that hasn't matured yet. This immediate access makes saving an indispensable tool for covering short-term needs or unexpected expenses where waiting isn't an option and you can't afford market risk.
And it's cheap to do.
Right. Generally, yes. Another notable pro is minimal fees. Savings accounts usually come with very low or even no monthly maintenance fees, especially if you meet certain basic criteria like a minimum balance or direct deposit. The main way you might hit fees is through those Regulation D violations if you make too many withdrawals in a month. But overall, the cost of holding and accessing your money is remarkably low.
Plus, it's easy.
Exactly. The ease of use is a significant advantage. Saving is incredibly straightforward, requires very little financial expertise. You open an account, deposit money, it earns interest, however modest. No complex research, no market analysis, no steep learning curve.
Yeah.
Universally accessible.
And the big one, the emergency fund.
Absolutely. Saving is unequivocally the best way to build and maintain an emergency fund. That financial safety net for life's inevitable curveballs. Whether it's an unexpected car repair, a sudden medical emergency, or the unfortunate event of job loss, is paramount. Having this liquid cushion ensures that you don't have to resort to high-interest debt like credit cards, or worse, sell valuable long-term investments at a loss just because life happened. It provides incredible financial resilience.
Okay, those are some strong pros. But there have to be downsides, right? What are the cons of saving?
Oh, absolutely. Despite these significant benefits, saving does come with some important cons that we must acknowledge, particularly when considering long-term financial goals. The most prominent drawback is low returns. The interest rates offered on traditional savings accounts are typically quite modest, especially when compared to the potential returns from investing. This means that while your money is safe, it's missing out on the potentially much higher growth that investment vehicles can offer over extended periods.
Which leads to that inflation problem again.
Exactly. This directly leads to a significant risk, the loss of purchasing power due to inflation. Because the returns on savings are often low, your money may actually lose value over time. Consider a scenario where inflation is running at, say, 3% annually. If your savings account is only yielding 0.5% interest, then your money is effectively losing 2.5% of its purchasing power each year.
That adds up over time.
It really does. Over a decade, that's a silent, insidious loss. Your $10,000 in savings might only buy what roughly $7,800 could at the beginning of that period.
Ouch.
Yeah. And finally, there's a significant opportunity cost associated with keeping too much money in low-yield savings. While safety and liquidity are vital for short-term needs, over-reliance on saving for long-term goals means you're missing out on the substantial growth potential from investing in assets that historically earn significantly more. It's like having a powerful engine, but only ever driving it in first gear. It's safe, but you're not utilizing its full potential to get where you want to go faster.
So what you're telling me is that saving provides that crucial safety net, that feeling of security and easy, quick access to your money. But it's certainly not a strategy that will make you wealthy or significantly grow your money over the long haul. It's more about preservation than appreciation.
Precisely. It's about preservation of capital and immediate accessibility, not aggressive wealth accumulation. It's a foundational element and indispensable part of your financial plan, but it's rarely the entirety of a robust strategy for long-term prosperity.
That brings us to takeaway number 3. Saving offers guaranteed safety, high liquidity, and ease of use, making it ideal for emergency funds and short-term goals. But its low returns mean your money's purchasing power can erode over time due to inflation. All right, now let's flip the coin and talk about investing. This is where we shift our mindset from preservation to truly putting our money to work, unlocking the potential for significant wealth creation. But as with any powerful tool, it comes with its own set of considerations and a different kind of financial commitment.
Yeah, and we connect this to the bigger picture of achieving your life's ambitions. Investing often serves as the primary engine for those most ambitious financial objectives. It's where you consciously accept a degree of risk in exchange for the expectation of substantial long-term growth. Let's really explore the significant pros of investing.
Okay, what's the biggest draw?
First, and perhaps most compellingly for anyone looking to build serious wealth, is the higher return potential. Investment products, particularly equities or stocks, have historically offered returns far superior to what you could ever expect from savings accounts or CDs. For example, as I briefly mentioned earlier, the S&P 500 stock index, representing 500 large U.S. companies, has generated an average annual return of roughly 10% over many decades.
Again, that's the average.
Right, the average. It fluctuates year to year, some years up significantly, others down. But this long-term average demonstrates investing's capacity to significantly accelerate your wealth accumulation. It helps you reach major financial milestones much faster than just saving alone. Imagine the difference between earning 1% and 10% on your money over 20 years. It's truly exponential growth.
And it beats inflation usually.
That's the second big pro, inflation protection. This is paramount for long-term goals. If you hold a broadly diversified collection of investments, particularly growth-oriented assets like stocks, you are very likely to outpace inflation over the long term. This means your purchasing power is not only preserved, but actually grows. This is absolutely critical for objectives like retirement planning, where you need your money to maintain or increase its real value over decades, ensuring it can still afford you the lifestyle you envision when you stop working. Without investing, inflation will silently erode your future wealth.
What about getting your money out? Is it liquid?
It often is, yeah. There's high liquidity, but with an important caveat. Many common investment products like stocks, bonds, ETFs are indeed highly liquid. You can typically convert them into cash relatively quickly, often within a couple of business days. On almost any weekday, the markets are open.
But the caveat is?
The crucial caveat is that the amount of cash you receive depends entirely on the prevailing market conditions at the time of sale. If you need to sell your investments during a market downturn, you could absolutely realize a loss and get back less than your initial investment. So, while accessible, the value is not guaranteed like savings.
So it helps you reach goals faster.
Definitely. Investing offers powerful goal acceleration. By earning potentially much higher returns, investing can significantly speed up your progress towards substantial financial goals. This could mean accumulating a large down payment for a future home sooner, building a robust nest egg for a child's education, or simply reaching financial independence earlier than you might have thought possible just by saving. It puts your money to work actively for you.
And you get to be part of the market, right?
Exactly. It allows for participation in broader markets. Investing provides you with a direct way to participate in the success and growth of global financial markets and profitable businesses. When you buy stock in a company or a fund that invests in many companies, you become a partial owner of those enterprises. This allows you to benefit from their innovation, profitability, expansion, even if you're not directly involved in running the business. It connects your personal financial well-being to the dynamism of the broader economy.
Okay, those are compelling pros. Now let's talk about the flip side. The cons of investing. This is where people get nervous.
Understandably so, and it's vital to be fully aware of the trade-offs. Perhaps the most significant drawback is that returns are not guaranteed, and there's a tangible risk of loss. This is the fundamental difference from saving. There is no assurance that your investments will yield positive returns, and you can absolutely lose money. The value of your assets is constantly fluctuating.
So that $10,000 could become $8,000.
Easily, especially the short term. While long-term averages are compelling, short-term volatility is a very real possibility, and you must be comfortable with that.
And you need to live it alone for a while.
Yes. Investing typically demands a significant time commitment. To maximize your chances of success and allow your investments to recover from downturns, you generally want to leave your money invested for at least 5 years, ideally much longer, 10, 20, 30 years. This means that money you anticipate needing in the near future should not be invested in volatile assets. It's a long game, definitely not a sprint.
It seems more complicated, too.
It can be. The complexity and research aspect can be a barrier for some. Investing is undoubtedly more complex than opening a savings account. It often requires some research to understand different investment types, assess your personal risk tolerance, and align choices with your time horizon. While tools and diversified funds have simplified getting started, successful long-term investing does demand a willingness to learn and stay informed.
And what about fees and taxes again?
Right, fees. While commission-free trading is widespread now for stocks and ETFs, there can still be fees associated with certain funds, those annual expense ratios for mutual funds, for example. or specific services from brokers. And importantly, you will owe taxes on any realized capital gains or investment income generated in a taxable brokerage account, which eats into your net returns. Understanding these costs is crucial.
Finally, it takes some mental strength, doesn't it?
It really does. Discipline and commitment are absolutely essential for successful investing. It demands a long-term perspective and the discipline to stick to your investment plan, even during scary market drops. Emotional biases like panic selling during a crash, driven by fear, or chasing hot stocks during a boom driven by greed can lead to impulsive, irrational decisions that severely undermine your long-term strategy and result in substantial losses. It takes mental fortitude to be a successful long-term investor and not let your emotions dictate your actions.
So it really sounds like with investing, you are making a deliberate trade-off. You're sacrificing the guaranteed safety and immediate access of savings for the potential of much greater financial growth. But that potential comes with inherent risks, requires significant patience, a longer time horizon, and a commitment to understanding how it all works.
Absolutely. The potential rewards for long-term investors are indeed significant, but they fundamentally come with inherent risks that must be fully understood, thoughtfully managed, and patiently endured. It's a journey, not a destination, and requires a different kind of financial approach.
That brings us to takeaway number 4. Investing offers higher return potential and protection against inflation for long-term goals, but it comes with the risk of losing money and requires a longer time horizon and more research. Okay, we've now meticulously laid out the similarities, the crucial differences, and the individual pros and cons of both saving and investing. So the really big question now is, given all of this information, which strategy is better for you? How do we apply these principles to our specific financial situations and goals? This is where the theoretical meets the practical, right?
That's the million-dollar question, isn't it?
Mhm.
And it raises an important point. It's really not about one being inherently better than the other in all circumstances. The optimal choice for you truly depends on your individual financial position, the specific nature and timeline of your goals, and your personal comfort level with risk. It's about making an informed decision, aligning the financial tool with the particular job at hand. Let me break down when I definitively recommend prioritizing each strategy.
Let's start with saving. When should that be the priority?
Okay, when to prioritize saving money. This is crucial for maintaining financial stability and liquidity. First, if you know you'll need the money in the very near future, generally within 1 to 5 years, a high-yield savings account, a money market fund, or maybe a short-term CD is almost certainly your best bet. Think about it. A typical market cycle, with its ups and downs, can range from 5 to 7 years. If your need for the money is sooner than that, exposing it to market volatility is just too risky.
Like saving for a wedding next year or a car down payment soon.
Exactly. That money needs to be safe and accessible. Second, and this is non-negotiable, building an emergency fund. This is the paramount reason to save. Before you even think about investing significant sums beyond maybe an employer-matched retirement contribution, you must establish and maintain a robust emergency fund.
How much are we talking?
Most financial experts recommend having enough to cover 3 to 6 months, ideally even more, of your essential living expenses. And this money must be held in a separate, low-risk, highly liquid account, like a high-yield savings account. This critical fund acts as your ultimate financial shock absorber, ensuring you don't have to resort to debt or sell investments at a loss when life happens.
What about debt?
Good point. If you are currently carrying high-interest debt, like credit card balances, personal loans, things like that, it is almost always financially prudent to focus on paying that down before prioritizing new investments. The guaranteed return you receive from avoiding high-interest payments, which can easily be 18%, 25% or more on a credit card, typically far outweighs the uncertain returns from investing.
So paying off debt is like a guaranteed investment return.
Absolutely. Think of it that way. You're securing a guaranteed risk-free return by eliminating a high-cost liability.
Can you give some concrete examples of when saving is the clear choice?
Sure. Specific examples for saving. Paying a child's college tuition if the payment is due in just a few months or a year. Accumulating a down payment for a car you plan to buy in the next 12 to 24 months. Saving for an upcoming vacation or a big household purchase within the next year. A down payment for a house you plan to buy in 7 years or fewer the shorter the timeline, the more saving makes sense. Funds for home improvement projects you plan to do soon. And to reiterate, your emergency fund that should never be exposed to market volatility. Also, money for covering very short-term obligations like monthly bills, rent, groceries, that always needs to be liquid.
Okay, that's clear. Now, when should investing be the priority?
All right. When to prioritize investing money? This is where you target significant long-term growth. First, if you don't anticipate needing the money for at least 5 years, and ideally much longer, 10, 20, even 40 years, and you are genuinely comfortable with some market risk, then investing those funds is very likely to yield significantly higher returns than saving. This is the money you are actively trying to grow for your distant future.
What about work retirement plans?
Absolutely critical. If your employer offers a match in your retirement account, like a 401k or 403b, contributing enough to receive that full match is arguably the most important investment you can make. It's literally free money, an immediate, guaranteed return on your contribution, often 50% or 100% on the matched portion.
Turning that down is like leaving money on the table.
Completely. Foregoing this is like turning down a significant raise. It's a powerful way to supercharge your long-term wealth building. Priority number one for investing, really. Then, once your emergency fund is solid and high-interest debt is managed, investing your extra disposable income becomes crucial for general wealth growth and achieving major long-term goals. This includes accumulating wealth for retirement, funding a child's education many years in the future, or saving for a house down payment if your timeline is truly long, like 10+ years out. This is where your money starts working hard for you.
And this is where compounding really kicks in.
Exactly. Investing allows you to fully harness the incredible power of compounding. When you leave your money invested for an extended period, you give it ample time to ride out market ups and downs and benefit exponentially from compounding returns. Your initial investment earns returns, and then those returns themselves start earning returns. It leads to exponential growth over decades. Like Einstein supposedly said, the eighth wonder of the world.
Are there tax advantages too?
Yes, significant ones. Many investment accounts like 401ks, both traditional and Roth, and IRAs, offer substantial tax benefits that further amplify your long-term growth. With traditional accounts, contributions might be tax-deductible, growth is tax-deferred. With Roth accounts, you pay taxes up front, but qualified withdrawals in retirement are tax-free. These advantages provide a powerful tailwind.
Can you give some specific examples for investing?
Sure. Specific examples for investing. Saving for retirement, definitely, through 401ks, IRAs, funding future college costs for a young child, using a 529 plan or similar where the money won't be needed for many years, saving for a down payment on a house you plan to buy 10 or more years in the future, building capital for starting a business much further down the line, maybe 5 to 15 years out, creating a substantial financial legacy for your family, a very long-term goal.
Does age play a big role here?
Hugely. Your age and risk tolerance should heavily influence your strategy. When you are younger, you possess your most valuable asset, time. This means you can generally afford to invest more aggressively, maybe more in stocks. Even if you experience short-term downturns, you have decades to recover and benefit from long-term growth. As you get older and closer to needing the funds, experts typically recommend gradually shifting towards more conservative assets like bonds or cash to protect your accumulated principal.
This truly brings home the idea that the choice isn't binary. It's really about strategic alignment, matching the purpose of your money and its intended timeline with the most appropriate financial strategy.
Exactly. It's about being intentional. It's about aligning the optimal tool with the specific task at hand to maximize its effectiveness for your unique financial blueprint.
That brings us to takeaway number 5. Choose saving for short-term goals, emergency funds, and high-interest debt repayment, and choose investing for long-term wealth accumulation, especially for goals more than 5 years away, and to maximize employer retirement plan matches. Okay, we spent a good amount of time discussing when to save and when to invest as individual strategies. But in the real world, for most of us, it's rarely just one or the other, is it? It feels like a truly healthy financial life, one that offers both security and growth, probably involves a deliberate blend of both.
You've hit on an absolutely crucial insight there. It is unequivocally true that most people benefit tremendously from a diversified, integrated approach that purposefully includes both saving and investing. It's not a matter of choosing one over the other for a complete financial plan. Instead, it's about seamlessly integrating them synergistically to address all facets of your financial life.
So using both together.
Exactly. This is the power of a healthy mix. You might, for instance, simultaneously keep a portion of your funds in a high-yield savings account to cover, say, your annual property tax payments, or to fund next summer's family vacation. That ensures that money is perfectly safe and accessible precisely when you need it. At the very same time, you would be diligently investing other funds earmarked for your retirement nest egg, a child's future college education, or maybe that long-term business goal, all held within a brokerage or retirement account.
So you cover the short term and grow for the long term.
Precisely. This dual strategy allows you to effectively cover your immediate and near-term needs with the safety and liquidity that savings provides, while aggressively pursuing long-term wealth growth and inflation protection through investing. It's how you build a truly robust financial foundation that provides both stability and opportunity.
This idea of blending strategies probably brings up some questions for people. Are there common ones you hear?
Absolutely. This concept often leads to a few common questions that I hear frequently, and I think it's essential we address them head-on.
Okay, like what?
Well, the first common question is pretty basic, which is riskier saving or investing? To be very clear, by its very definition, saving entails an incredibly low level of risk. Your principal is typically protected, especially with FDIC insurance. Very little chance of losing the money you deposit. Investing, on the other hand, always comes with the risk of losing money. Its value is tied to market performance, which can fluctuate unpredictably. So, unequivocally speaking, investing is inherently riskier than saving. That's fundamental.
Makes sense. What else?
Another frequent question. Why do some people prefer to save rather than invest, even for long-term goals? There are several valid reasons. Some individuals just prioritize that profound sense of security and peace of mind that comes with having readily available guaranteed funds. They value immediate access and principal preservation over potential growth.
Maybe they have lots of short-term goals too.
Exactly. Others might have a larger number of significant short-term financial goals that necessitate money being held safely and accessibly. A significant factor can also be a lack of knowledge or expertise about investing, or maybe just a deep-seated discomfort with the inherent market risk. Fear of the unknown or fear of loss can be powerful. And unfortunately, some folks may simply not have enough disposable income after covering essentials to dedicate to investing, making saving for immediate needs their only real focus.
Okay, here's a big one. How much money should be saved versus invested? Everyone wants a magic number. If only it were that simple. This is truly not a one-size-fits-all answer. It depends entirely on your unique goals, risk tolerance, and life circumstances. However, a very practical rule of thumb is this. First, save enough to comfortably cover 3 to 6 months or even more of your essential living expenses in that emergency fund. Make sure it's liquid and safe. Also, ensure you always have sufficient funds in checking for short-term obligations like bills and groceries.
Once that's covered.
Once those foundational steps are firmly established, and assuming you've addressed any high-interest debt, you should then seriously consider investing the rest of your disposable income. The specific percentages and amounts will naturally vary significantly based on your age. Younger folks can often invest more aggressively your income level and any existing debt.
Okay, last common question. Why do some people struggle with investing? It seems hard for many. It can be. It's a complex area, and several factors can make successful investing challenging. A very common barrier is indeed a lack of knowledge or practical experience, which can lead to inaction or being overwhelmed. A major culprit is often emotional biases. We talked about this fear during market downturns triggering panic selling, greed during booms leading to chasing hot stocks.
Getting caught up in the moment.
Exactly. Successful investing demands a rigorous long-term perspective, unwavering discipline to stick to your plan, and immense patience to ride out volatility. Maintaining these qualities, especially when your portfolio value is swinging wildly, can be incredibly challenging for human psychology. It's often a battle against your own emotional responses.
So, if I'm understanding you correctly, it sounds like the ultimate key to comprehensive financial well-being isn't choosing one path over the other, but rather consciously creating a balanced financial portfolio that intelligently incorporates both saving for critical safety and liquidity and investing for robust long-term growth. It's about designing a system that works together.
Precisely. You've captured it perfectly. It's about finding that optimal balance tailored to your unique needs and goals, enabling you to achieve both unwavering stability and significant long-term growth simultaneously. It's an active and ongoing process of financial optimization, not a set-it-and-forget-it thing entirely.
That brings us to takeaway number 6. A healthy financial plan typically involves both saving for liquidity and safety and investing for long-term growth, with the balance depending on individual goals, risk tolerance, and ensuring foundational needs like emergency funds are met first.
So this deep dive has really highlighted that saving and investing, while they might seem similar on the surface, are distinct yet profoundly complementary pillars of any robust financial strategy. Understanding these crucial differences isn't merely academic, it's genuinely empowering. It places you firmly in the driver's seat of your financial future, allowing you to make intentional, informed decisions rather than just passive ones.
Yeah, and as you, the listener, reflect on everything we've explored today, I really encourage you to genuinely consider your own financial landscape. Are you currently prioritizing the right strategy for each of your specific goals? Have you built that crucial emergency fund to weather unexpected storms while simultaneously making sure your long-term wealth is actively growing and working for you? What does it truly mean to make your money work for you, not just for today, but for decades to come, enabling the life you aspire to live? The profound power of consistency, coupled with applying the right financial approach for each dollar you earn, can genuinely transform your financial future. Remember, it's not about achieving perfection overnight, but about being consistently intentional and strategically aware.
Ultimately, a thoughtfully constructed, well-rounded approach that seamlessly integrates both disciplined saving and strategic investing can build substantial lasting wealth, provide essential protection against unforeseen financial shocks, and establish an incredibly secure foundation for your future, truly allowing you to pursue your dreams with confidence and hopefully some peace of mind.
Okay, let's quickly recap our key takeaways from this deep dive, just to solidify these vital concepts for everyone listening. Takeaway number one. While both saving and investing help you accumulate money for the future and use financial institutions, saving is generally for short-term goals and emergencies, while investing is for longer-term wealth growth.
Takeaway number two, saving offers high safety and liquidity for short-term needs with lower returns, while investing provides the potential for higher long-term growth but comes with greater risk and value fluctuations.
Takeaway number three. Saving offers guaranteed safety, high liquidity, and ease of use, making it ideal for emergency funds and short-term goals, but its low returns mean your money's purchasing power can erode over time due to inflation.
Takeaway number four, investing offers higher return potential and protection against inflation for long-term goals, but it comes at the risk of losing money and requires a longer time horizon and more research.
Takeaway number five. Choose saving for short-term goals, emergency funds, and high-interest debt repayment. And choose investing for long-term wealth accumulation, especially for goals more than 5 years away, and to maximize employer retirement plan matches.
And takeaway number six, a healthy financial plan typically involves both saving for liquidity and safety and investing for long-term growth, with the balance depending on individual goals, risk tolerance, and ensuring foundational needs like emergency funds are met first.
That's all for now, folks. Please like, share, and subscribe for more like this.